Hey fools, these days everybody is talking about interest rates, myself included. It's a dynamic environment, everything's changing, it's fun to talk about. However, I think if we stop to smell the roses for a minute, there's a bigger problem looming in the economy just around the corner. I'm thinking 2014, 2015 here. First, let me give you some numbers. In the second quarter, Bank of America reported that 47% of its revenue came from net interest income. It was north of $10 billion. Net interest income is just an accounting way of saying the money they made from their lending business. Very strong. It also reported a 40% increase in its mortgage originations. That's $25 billion. That's a huge, fantastic result. People's United Financial, a successful regional bank in the northeast of the U.S., reported that its commercial loan portfolio grew 14% in just the past 3 months. That is from March 31st to June 30th. 14%. That's $750 million in new commercial loans in 3 months. Remarkable. A fantastic, fantastic number for the quarter for that bank. But things are not always so rosy. US Bancorp, one of the highest performing banks in the country, reported that its mortgage unit was down, $94 billion quarter over quarter. It also reported that 65.5% of its revenue came from net interest income. So they're highly reliant on their loan portfolio to the tune of 65% of revenue for that to continue. So that's where their growth will come from in the future. Well, here's the problem, fools. When the Fed eases quantitative easing, when the interest rate rise, when there's not as much cheap, easy money floating around in the economy, it's going to be up to the American consumer to take the place of that stimulus. The American public is going to have to go out and have the wherewithal and have the job and have the income to feel stable enough to go out and buy that new home. They're not going to want to refinance anymore. That wave is probably over. The economy added 162,000 jobs last month. The unemployment rate is currently 7.4%. It declined from 7.6%, but that decline in the percentage was driven more by workers leaving the labor force. The labor force today is only 63.4% of Americans, which is an incredibly low number, and that trend is continuing downward. 24% of American youth don't have a job that want one. Just under the numbers of that 7.4%, it looks like the labor market is still remarkably weak, and I'm not sure that the consumer base in the U.S. has the steam to be able to power through once the easy money is gone. It makes me very nervous for 2014, very nervous for 2015. So fools, as I'm anticipating and thinking, what am I going to invest my money now for what will happen in 2014, 2015? What are the indicators? I'm looking at that unemployment number overall, the net growth. Until that number goes over 200,000 new jobs net per month, I'm very nervous. If the economy can change gears, pick it up a little bit, and we can clear that 200,000 threshold, I'll be feeling a lot better. I'd expect the Fed to be eased much more quickly. But in the meantime, I'd be cautious. Things are not looking so great for the consumer demand side.